Dipen said, good morning, thank you for joining us. Dipen, how much more to go for markets before you think that we have a firm bottom in place for mid and small cap stocks?
So that's a difficult one to call, and frankly, I would say that we have to be cautious in this year. It's not going to be like 2017. We are not going to get a one-way ride. There is just too much of uncertainty floating around. The smart guys, like you said, are beginning to sense that maybe some of the greed in the markets might yield to fear over a period of time, and this might be just the year when that happens. I don't want to sound like a doomsayer here right now, but frankly, there is very little of rational money left to be made at this point of time. So, if you are a mid cap junkie, you will still go out and buy the fallen mid cap angels, as I would call them. But the more mature investors are going to be a little more circumspect this year.
So, what should an average HNI stroke retail investor do? Because these are testing times, and let's be real, for those who are active in the market, 60 to 70% of their portfolio has been in mid and small cap stocks, because for those who are in market and those who watch our shows regularly, they are not the SIP investors. They come in for instant gratification, whether it's 1 day, 2 day, 3 months, 6 months, 1 year, that's debatable. But there is a large variety of our viewer base which is here to make quick money, and unfortunately, because of the meltdown in mid and small cap stocks, either they have lost their gains or they are losing money.
Right, that's a very fair question to raise. I think if you've made a hell of a lot of money in mid caps and you've lost a little bit recently, without getting into the stock specific discussion, I think you can still take money off the table. It's not a problem. I think from here, for mid caps to deliver, and as a group, of course, as a class, to deliver meaningfully over the next 6 to 12 months is going to be an uphill task. I don't think it's going to happen. That said, there are always high quality exceptions. So it's not that I want you to sell lock, stock and barrel, but a lot of the mid caps are looking challenged. And I think the biggest thing here in the mid cap space is lack of liquidity and the fact that interest rates are heading higher. So high PE multiples cannot coexist with higher interest rates. I think there is more risk than reward in the mid cap space. Of course, there will be good stocks worth buying, and that is the kind of opportunity that one should wait for. But if one is already invested, and if some of the stocks where one is invested are not really high quality names, then an exit at just about any price is okay.
Dipen, hi, morning. And would metals be that space, given the underperformance that we've seen year to date and the fact that 2017 has been very solid, assuming that, you know, the cyclicality is still benefiting metal as a play, would you be a buyer in the dip that some of these metal stocks have given off late?
So frankly, we don't have, officially speaking, we don't have coverage on most of the metal names. We think these are global cyclicals that are best left to global brokerages to figure out. There are so many linkages, barring perhaps for someone like a Coal India, there are so many linkages with global events that it's difficult to take a call. A lot of them, like Tata Steel, actually have large moving parts overseas rather than India in any case. So I think this is a very difficult space to call. We have stayed away from it, and frankly, I cannot give you a view cast in stone here. Sorry.
Point. What about IDBI Bank though? And I'm not really asking you to give us a stock recommendation here, but now it seems that it's a done deal. The IRDA as well has given its green signal for LIC to go ahead and buy that 51% stake. We still don't know the valuation at which the deal is going to happen. That only depends on SEBI. But the number being talked about is 13,000 crore rupee, and that's only the initial sum that IDBI or that LIC is going to put in for that 51% stake, and then, you know, to capitalize the bank and make sure it's up and running. It's going to be a long drawn process, Dipen. Seems so.
Yes, it is. And I think what's interesting here is the basic fact, the basic contour of this case is something that holds true for a whole lot of the PSU bank pack, not just an overbeaten name like IDBI. I think the last year of accelerated stress recognition, prodded as it was by the RBI, has perhaps still not led to the kind of I would say stress recognition that gives us as investors confidence whether the worst is behind. This is one part. So whatever kind of adjusted book value that you might want to bake into the numbers is a function of the kind of stress recognition that has officially taken place. This is point one. Point two is, here on, how many of the loans which are even good and arguably good through as seen through today's filters are going to remain good. So, and it's not just the PSU bank pack here. So you have large private sector banks like an Axis Bank, which is sitting on, I think, about 9,000 crores of sub-investment grade loans. So I don't know how much more of the worms are going to crawl out of the woodwork, whether the woodwork is in good shape. So when you ask me whether 13,000 crores or 20,000 crores or 30,000 crores is a good number, there's no way I can give you a confident answer. I think there's a systemic problem in recognizing and providing for stress in our banking system. There is also a systemic problem in terms of solving that stress, which is largely being met. I think it's a slow process, but it will happen over a period of time in the IBC or NCLT resolutions as we move forward. There are 2 or maybe 3 cases which are kind of getting resolved even as we speak. And the claims that things can get completely, all the 12 headline cases will get solved by maybe September is an ambitious or is a bit rich, if you ask me. But even if it gets solved by March, if we see half a dozen cases getting solved by September, another half a dozen getting resolved by March, I think that should set the tone for a sentimental recovery. But to put a fix on numbers today and to say with any confidence whether X or a Y number for valuing a PSU bank is right, I think that's indeed very, very challenging.
Okay. So I'll talk about the stock ideas. You continue to like ICICI Bank, and somehow when I look at ICICI Bank, it's got all the ingredients of why the stock should be going higher. Subsidiaries are doing well, excellent valuations. Now confusion at the top also slowly seems to be getting sorted out. But somehow attractive valuations and the environment and the positioning of subsidiaries is not helping the stock.
So one of the things I've written in the mail this morning to you is that building a large cap portfolio is something that requires patience, especially at stormy times like this. I think ICICI Bank, if we are going through a macro storm of sorts as a country, I think ICICI Bank is going through a much bigger storm. So whether it's management change, whether it's a heavy level of stress on their books right now, whether it's some of the other concerns around resolution of stress at the NCLT IBC cases, like I said earlier, I think it's all coming together. This is the worst that you can see ICICI Bank going through. Remember, it's built a superb retail franchise, whether on the assets or the liabilities side. It's built a number of wonderful subsidiaries, including insurance, broking and asset management subsidiaries, which come immediately to mind. Headline valuations are arrestingly low, if you ask me today, at less than 1.5 times adjusted for subs. I don't think there is much more to lose here, but yes, you might see 3 months or 6 months of drift. I think if there is faith to be placed in things eventually turning around, I think it's in some of the private sector banks rather than the public sector that I should see the first signs of a turnaround, whether on the business front or whether in terms of then the follow through investor sentiment, which will happen once the business turns around. So both Axis and ICICI would fall into that category. Our preference is clearly for ICICI Bank, given the fact that we suspect much more of stress recognition might play out at Axis Bank. So we would go out on a limb here and say, okay, nothing might happen for the next 6 months, but if you're going to do a stock SIP in a large financial name today, it has to be ICICI Bank.
You still like Sun Pharma and Lupin, and again I understand that this is not a great environment, but my understanding when I met the management of Lupin and Sun Pharma is that the board is still heading towards the rock. There is no shore in sight, and the reason when I say that there is no shore in sight is because they are not very confident of when the pricing power will erode and by how soon they will be able to go to complex generics. So from a market standpoint, why should one get excited about buying Sun Pharma and Lupin right now? I mean, they could remain in time-wise correction for another year, maybe 2 years.
I don't know about 2 years, Nikunj, but a year would be possibly the worst case, and which is why I would add these stocks also to a stock SIP for serious long-term investors. And here are some reasons why. The last 2 or 3 years has seen a steady and sharp erosion in the price of generics in the US. We are seeing recent evidence suggests that much of that price erosion is actually easing out now. From high double digit, you are now to middle or maybe high single digit. So this is one part. The deterioration in the quality of the business has slowed down. I'm not saying it's gone away completely. Even in the face of this deterioration, you would have expected short-sighted managements to close the tap on R&D expenses, and they haven't done that. Whether it's a Sun, whether it's a Lupin, whether it's a Cadila, you name it. And these guys have been spending in the mid-teens in many cases as percentage of revenues to on R&D. So look at their adjusted margins, and they've been expensing out these spends completely. And somewhere these high spends into R&D are likely to deliver, and they're likely to deliver, as you said, although you're a little more impatient than I am, on the complex generics bit. So there's a whole line of complex generics which is going to get released between, say, 6 months from now for the next 2 or 3 years following that, or maybe a year from now. And I think for high quality companies, it's the promise and increasing visibility on the promise rather than the actual delivery when it comes. That's the thing that investors do. So maybe these guys will see run-ups in stock prices even as earnings go through another quarter or two of decline. That's the suspicion I have. Yes, you might accuse me of having a much longer term faith and a much higher level of faith than what you do at this point of time. I'm happy to disagree today, and hopefully I will be proved right in some time. This happened to us as research analysts when we were among the earliest in the street to take a call on IT. That's a different story in a different context, but we are still very bullish on IT, by the way. And someday I suspect you will call me back on this show and tell me that I was right today on pharma.
Well, I would like to compliment you on your call here on IT. I think you were the Lone Ranger that time. Right now the Lone Ranger, but sometimes it pays to be a Lone Ranger because that's the time you really get bargains. Would you like to call yourself as a Lone Ranger in private banks by calling a sell there, or you want to be part of crowd there?
No, so you know the thing about high quality businesses is that you write a sell on them when you see a change in the when you see a deterioration in the quality of the business, and not just because you see valuations being high. I completely agree that private bank valuations look high today, and I'm not talking about all of them, but if you look at an IndusInd Bank, let us say, but that doesn't make me less than constructive on them. So right now, given the published target price that we have on IndusInd Bank, technically you might say that it's in neutral zone. Does that make me less bullish about their future as a stock? I don't think so. A company that's so look at the smaller banks there. A City Union Bank, which is an excellently managed bank, consistent 1.5% ROAs, and not showing any decline, any sign of letting go of that franchise, and 2.5 times and a little more on F20 basis also doesn't scare us. An IndusInd Bank in the making, if I would call it, is an example like RBL, where we are building in faith and we don't mind giving them even 3 times adjusted book on FY20, given the fact that we see their microfinance stress falling off, their retail book growing, their spreads increasing. So there's a whole lot of candidates there, but it's not that we are blindly biased. We have blind bias on all the private sector banks. We still have a neutral on Axis, where we are cautious on future asset quality, especially for the next 2 or 3 quarters. We are flying a kite, I must say, on KVB, where there are early signs of a turnaround, but 2 more quarters of maybe 1 more quarter of stress recognition. But here's a very high quality management which is going about clearing up the mess at the bank, and we are building in longer term faith there at KVB. So I think unless the sector does something that is silly, or the bank in question does something that is silly and changes the longer term momentum and direction or trajectory of the business, I think we would be loath to convert our buys into sells early in the game. No way.
Clarify here for our viewers that KVP means Karur Vyasa Bank. So Dipen as a house, so HDFC Securities as a house, and Dipen is endorsing Karur Vyasa Bank for the kind of franchise value they are trying to create. So Dipen, before we wrap it up, out of this so-called old age South Indian private banks, Federal Bank, Karnataka Bank, Karur Vyasya Bank, City Union Bank, you would say you would endorse Karur Vyasya Bank?
So the best performing right now is City Union Bank. I see them as continuing to perform the way they've been performing. The most consistently performing old age South India based private sector bank is certainly City Union Bank. Federal Bank is the largest of the lot. They've kind of stumbled and fumbled over the last 5 or 6 years, and they've oscillated between brilliant performance to dull and uninspiring. I think they should be able to get their act together, but it's somehow not happening. Some or other box is always left unticked by them. But I must confess that at the core, Federal Bank is also a super franchise. And if they get a few shots right here, I think Federal Bank is also now at 80 odd rupees. So we downgraded them in the last quarter, and I think Federal Bank is getting into value territory, and there's nothing fundamentally wrong with the bank. Let's look at it that way. But if there's a bank out of all these, if there is a bank that we would like to build out a long-term thesis and probably suspect that there is maximum alpha to be made in case our thesis plays out right, is most certainly Karur Vyasya Bank.
Okay, Dipen, great speaking with you. Thanks as always for taking the time out and sharing with us your wisdom on what to buy, what not to buy.